I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com. He's speaking to us from the Chicago area. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim. My pleasure.
Copper has made a strong charge since the start of the year. What's behind that?
Well, one of the things I've been watching in copper is just the overall wave structure of it. And I've been talking about this in my Inside Track monthly newsletter. And when we saw that nice sell-off back in February through May, it went right to its downside targets, went right to 6 to 12 month support, explaining it hopefully briefly, but copper had seen a nice wave structure to the upside, saw an initial rally in January through March of 2016, then a pullback, then a much bigger rally from June 2016 into February 2017. So from if you were an Elliott wave person, that would be the third wave, the more dynamic wave, but it tells you that you still have one more impulse, one more advance to come after an intervening pullback. And when you're looking to see if that is an accurate wave, and I don't get obsessed with wave counts and don't even spend a lot of time and energy on them, but there are certain key factors you could take from Elliott wave theory and that are very useful and pretty consistent. So I get a lot of different opinions on Elliott wave, but for me, I'm not going to throw the baby out with the bathwater. There's some good things to take from it, and one of them is just the very decisive nature of the low immediately preceding a final advance. So in copper, we had a low in late December, then it rallied into February up to new highs. That previous low from late December becomes both a target for the ensuing decline from the February peak, and it also becomes a 3 to 6 month support level if the perception is accurate that copper is going to head to one to 2 year high before what's now a year and a half bull market reaches fruition. And so you had that low from late December down around 245, 246. That became the downside target from the early February peak, and copper came right back down to it, spiked down to 246, 247, did it along with cycles in early May, and that just told me that we were getting ready to enter that next advance. We've seen it. All my weekly and monthly trend indicators corroborated it, and so my conclusion for the last couple months has been that copper needed to rally back above its February highs up in the mid 280s, and then likely spike above there, where I really see the resistance for this 3-month uptrend, and also the resistance for the overall 18-month uptrend is up around 296 to 299. So that's been my focus, and I think that that's where copper's heading, and that's where it's really going to make the the most important decision as to whether that's the completion of this year-and-a-half bull market and we see some consolidation, or whether it enters more of a parabolic uptrend and really accelerates to the upside. I'm leaning far more to the idea that we peak somewhere around that $3 level and enter some consolidation before copper would be ready to enter another sustained advance.
China a year ago said it expected to have 6.9% growth, and every quarter since then they always announce, we just had 6.9% growth. Maybe for once the numbers out of China are accurate?
That could be. It's nice when you have a more controlled environment where when you set your goals and publish them, you miraculously meet them to a T every time. So that's a very nice thing about that overall more controlled environment, we'll say. But yet it certainly could be that you're seeing some growth pickup in many places around the world. Doesn't mean that it's a long-term sustained thing, but it certainly does jive with with the outlook for inflation, commodity inflation, to slowly pick up in 2016, 2017, and then start accelerating in 2018, 2019. Fits with that very nicely, and with the stock market continuing higher. So, and the dollar heading lower too, which certainly helps that inflationary scenario, at least on a 3 to 6 month basis. But again, I think that we could be getting closer to a peak in that overall scenario, where we enter more of a consolidation phase for a couple months. And there are certainly some signs in a lot of the global equity markets that things could be slowly rolling over. As has often been the case, the U.S. is slower to reveal those warning signs, but looking at a lot of the European indices, they're starting to reflect some slowing, and it wouldn't surprise me to see Asia start to reflect the same thing in the coming months too. So that could certainly reinforce the idea that we're coming to an intermediate peak or culmination here in the next couple weeks.
We'll have more with Eric Hadik right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Eric Hadik. Eric, the Canadian dollar has been on a nice move up, and the price of oil has gone up slightly the last little while. Are they still closely connected, or has the dollar disconnected itself from the price of oil, the Canadian dollar?
Yeah, I think I've seen more of a disconnect this year, where really the Canadian has strengthened even when oil was going through some more swoons within its overall trading range. I think that it just reinforces what I call my axiom of market correlation, and I think I've cited this before, but the idea it's more than an idea. It's something that has proven out time and time again, and that there's a real danger to looking for too close of a correlation between markets like that. Even, when you talk about inverse correlations of the dollar and gold, or correlations of gold and inflation, all the different correlations that people will throw out there, they tend to really be the strongest or move in closest tandem when the lead market, whichever one of those two typically sets the tone for that movement. So with Canadian and oil, you're kind of looking at oil as more of the lead market and the Canadian dollar responding to it. But when that lead market is in an accelerated move, or even a parabolic move, or if it has broken key support or resistance levels, and I'm talking typically multi-year support and resistance levels, those are the times when traders pay the closest attention to that lead market and to the correlation. It's when they start talking that correlation up much more, and you see a reactive move in the lagging market. So in that case, the Canadian dollar. When the lead market gets into more of a trading range and a consolidation phase, where maybe it's locked in the same range for 6 months, for 12 months, the correlation often just, goes where, down the drain, and you see each market kind of trading on its own day-to-day, week-to-week driving forces, fundamentals, technicals, whatever may have the strongest influence right then. But so I'll often get inquiries saying, okay, well, how in the world can the Canadian possibly be going up if crude has dropped for the last week or dropped for the last 2 weeks? And it's because you're in this phase where the correlation has really unwound, and you don't really expect it to have much impact until the lead market gets back into more of a trend, and not just a trend, but a more accelerated trend. That's when you see those correlations really take hold and drive the interplay between two markets like that. So all that to say is, I think that we are in more of that type of sideways trading range when you look at both the Canadian and crude over a 1 to 2 year period, even a 6 to 12 month period. So you don't see nearly as close of a correlation between the two.
We'll have more with Eric Hadik right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Eric Hadik. Eric, gold is down slightly, around $12.47 as we speak. What's the picture for gold, short-term and then long-term?
Well, on a long-term basis, excuse me, I still am sticking with, and gold continues to corroborate my overall outlook that we would see a major 3 to 5 year bottom in late 2015, that it would see an initial rally of greater duration and magnitude than it had seen in 3 or 4 years during 2016, which that was fulfilled. So that was kind of a first wave. Then it would see a sharp decline into late 2016. That's your second wave, which often retraces most of the first wave. That's a very common occurrence. And then in the first 6 to 9 months of 2017, you would see something similar to that scenario, but on one lower magnitude, one lower degree of wave structure. So instead of a 6 to 7 month advance like you saw in 2016 in gold, I was looking for about a 4-month advance to start, and instead of that 5+ month decline we saw in 2016, I was looking for about a 3-month decline. But there was a lot more went into that. Was just a general structure. In fact, I had just given a rough sketch of that in the beginning of this year, and gold has adhered to that so far. But from within that longer term perspective, my thinking was that the third quarter of 2017 was when gold would set another pullback low and then begin to enter a more sustained advance from there. So once you get into fourth quarter this year and then 2018, that gold would be mounting a more sustained rally. But even in the early stages of that third quarter this year and possibly stretching into late 2017 in something like the gold stocks, that you would see divergence between gold, silver, and gold stocks, each of them setting lows at different times and initially responding a little bit differently until gold gets into that more convincing trending market in 2018. And there again, that kind of loosely applies to what I was talking about a few minutes ago with the market correlation, that gold stocks often are not following gold that closely because they've got many other factors impacting the value of their stock, not just the price of the metal. And it's only when gold has its more convincing moves up or down that something like the gold stocks follow in very close lockstep with the price of gold. So that's something I would expect to see out in 2018, but for the rest of this year, I think you're going to continue to see the kind of divergence we've seen already. A perfect example was earlier in the year when gold stocks peaked in early February, and the metal, gold, continued to move higher on balance into April. And even on the declines that we've seen, most of them have been of more significant proportion or magnitude in the gold stocks, whereas the metal had held up better through most of that. And I think you're going to see some more of that in the coming months. But there's coming a time, and there are key price levels that need to be met. And at that point, I think is when you're going to see the onset of a more sustained up move in all those arenas, gold, silver, and the gold stocks.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com. He also has the website 17yearcycle.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.